All right. So thank you, everybody, for joining us tonight on our Social Security presentation. This is obviously our April knowledge series, and we always truly appreciate the attendance and the import of this knowledge series that we try to put together every month, in which we try to bring unique financial planning ideas and conversations, as well as some more lighthearted information to you. And we'd love it as you join us for more of these knowledge series, for you to spread the word, because we want to use this as an outreach tool as well. But it probably needs no introduction to say that Social Security is a core element of the financial planning process. Our clients are asking questions such as, is it better to take Social Security early? Should we defer and take it later? And in truth, something like 85% of all Social Security recipients take their Social Security at full retirement age. But it's good to know the nuances and the financial impact of taking it early and getting more years to collect and spend as a gap to maybe pension income or IRA income, versus deferring it and getting a much higher payment but foregoing those years. We also get questions regarding spousal, widower benefits. We get questions about dependent children at home and how we can get paid for income in that scenario. So while most people just kind of dial it in and take full retirement and talk to the Social Security Administration and maybe visit a branch and get their important questions taken care of, at least it's an important subject for people to feel that they have command of, so that they're not out in the dark, so that they feel that they're not making a choice that they'll regret down the road. And it just in general, it's helpful to be knowledgeable about important financial processes. So to help explain Social Security, and for our presentation tonight, which is called 5 Things You Need to Know, we have our resident expert, Grace Bumpus, to lead us in this conversation. And we want to say thanks to Grace, because she's out on the road working with other advisors, I think now in Texas, and I believe she's in the Boston area. So she's on the road, yet she's making time for us. So thank you for that.
Absolutely.
Grace is a senior wealth planning specialist at Franklin Templeton, which is a large asset management company. And they have, among their many resources, the Franklin Templeton Wealth Management Academy. Grace is responsible for developing and delivering wealth management content, educational programs, marketing initiatives, and just training in general to financial advisors. Prior to working for Franklin Templeton, she was at Putnam, which is a venerable old Boston asset management group, and she has a degree in financial something from Boston College, which of course is a great university. She has a degree in finance from Boston College, which is a great university, but for their hockey team that frustrates me year in, year out, but different. So Grace, thank you for joining, and I turn it over to you.
Awesome. Well, thank you so much for having me. It's nice to meet you all. And my role on our team is to be a value add. And hopefully today, we can answer some questions that you might have, some concerns, and also just provide education around the ins and outs of Social Security. And I'll probably cover content for roughly 20-ish minutes or so, but please use the chat feature. Happy to answer and address any questions at the end. Also, because every scenario is different, if you'd like to have more of a one-on-one conversation about your scenario, please reach out to your advisor, and we can absolutely make that happen in a follow-up. Hopefully this isn't our last conversation. But today, sorry about that. Here's the agenda again for the next 30 minutes. I'll go through some facts and figures around Social Security, the ins and outs of Social Security, and we can close with some case studies, if you will, that take real life people, real couples, and explain why they chose to do a certain claiming strategy. So, with that, we can get right into the facts behind it. So, over 70 million Americans are receiving Social Security benefits. And over 60% of those beneficiaries, Social Security provides the majority of their cash income in retirement. And as you can see, the last bullet here, a lot of people are relying on Social Security, but we're also hearing in the news that is the trust fund going to be around forever, right? There is a worry that come 2034, that trust fund is going to be depleted. So when I do calls like this on any financial planning matter, even if it's not Social Security, this question is always asked during Q&A. So we'll address that as well. So getting right into the importance of this conversation and why Social Security matters is really covered on this slide. These 5 main things make it very unique. Number 1, longevity. Social Security will outlive you, right? Your earnings record can outlive you. There's not many things that can do that, right? It also keeps up with inflation. So that's that cost of living adjustment. You might hear announcements on an annual basis like, hey, in 2033, it was close to 9%, the COLA adjustment for the year. 2024, it's roughly 4%. But again, a dollar today may not be worth the same 10 years from now. So Social Security trusts to take that into consideration.
Would you go back and just give me those cost of living increases for 2023 and 2024?
Yeah, so I think 2023 was 8.6, I want to say.
That's a lot.
Yeah. And for this year, it's either high threes or close to 4%, which is still higher than average. And while we're on this type of conversation too, a lot of people, when they become eligible, which is at age 62, in a year where there's an increase, let's say of 8.6%, they're like, hey, I want to lock in that high amount. I want to make sure I'm getting that growth. Once you become retirement age for Social Security, that will be included in your end calculation whenever you choose to claim. So even if you don't lock in 2023, you're not missing out on that growth.
Oh.
So I think that's something important to note too. And then of course, markets. We can't control when we retire and how the markets are doing at that time. So it's great to know that there's going to be a source of income that won't be affected by market performance at that time. When it comes to taxes, it is very likely that the majority of your Social Security will be taxed because those income amounts that will be impacted are pretty low tiers, and we have a slide solely dedicated to that. But only up to 85% of your Social Security can be taxed, not the full 100%. And then lastly, here, it's right on the slide, it's a guaranteed source of income in retirement. And for a lot of people, it's their only guaranteed source of income. So it's a great resource, which is why we want to make sure we use it properly and we set ourselves up for success. Now, this is a pretty busy slide here, but this is really going through the idea around the trust fund of Social Security depleting come 2034. And if you think about this timeline, at the beginning of Social Security, a lot of people were working and they were paying into the system. So Social Security was receiving more payments than they had beneficiaries, in a sense. Now, just because of the way the world is right now and the way generations have been, it's probably no surprise to all of us that, especially due to baby boomers, there's more individuals taking Social Security and claiming Social Security than paying into the system. So that 2034 trust fund depletion doesn't mean there won't be benefits. It just means their savings bank that's may hit zero. So any payments being received would be directly from individuals paying into the system. Now, this isn't the first time we've seen adjustments be made to the world of Social Security. In the 80s, there was adjustments. So there are ways that not just Congress can address this, but also the administration themselves. So what you're seeing on the slide here are a handful of ways that Congress can make changes to Social Security to avoid that trust fund depletion. Because if we hit that, we could see benefits be cut by roughly 20%. But no matter who is president at the time and however Congress is made up, you do not want to be the sitting president when that happens, right? So they will adjust this, right? I'd agree with that. So here are some examples of how just taxation wise they can address Social Security. But this next slide is really great too, because it goes into how
And
Social Security.
would you mind going back to that one?
Yeah,
I just wanted to read through it just a few more seconds.
absolutely. Yep. So the focus, classic, it's all about increasing taxes, but it's also different ways that it's being different brackets or thresholds that may be taxed. And maybe individuals will be taxed at different rates as well. So here are a few things that can be addressed. And while we're on this slide too, those of you at home, don't feel like you have to write all of this down. We can follow up with a brochure that covers these ideas and or these slides as well. So we can use that in the future. Now, this slide covers how Social Security, the administration, can address the depletion. Just due to longevity being a risk now, right? Individuals living longer, that will come up a lot in this presentation. They can increase that full retirement age, meaning the age where you can fully maximize your benefits, right? So instead of taking the 35 highest earning years, which I'll touch on in a few slides, they can take more years than that for the calculations, right? There's many things that they can do when it comes to addressing the issue of the trust fund depletion. And that's what those last two slides were covering. Now we're getting into it, again, this has all been setting the stage, but look at that number on the screen. So an average retiree benefit for over 20 years is over $300,000 from Social Security. So I don't care who you are, that's a big chunk of money, right? So we want to make sure that we're doing this properly. And that's where understanding the basics come in. So what we're seeing on this slide is really getting to know the fundamentals of Social Security and just eligibility. Hey, am I eligible? If you paid into Social Security, which you're seeing on that second circle there, through a payroll tax, then if you've worked at least 10 years or 40 quarters, that's what's equal to 10 years, you will be eligible. But if you can see benefits wise, Social Security, the benefit you receive on a monthly basis will be based off of your 35 highest earning years. So if you only work, let's say 10, 15 years, in that calculation, there will be a lot of zeros. And then on the opposite side of things, let's say you work 40 years, your 5 lowest earning years, they won't take into consideration. And a lot of times, the longer you are into your career, those are typically your higher earning years. So the estimates you see from Social Security, you could definitely get higher than that because it's adjusted on an annual basis. Lastly, a little loophole to the first part of eligibility. Even if you didn't pay into Social Security at all, never worked, or let's say only 5 years, you can still be eligible on your spouse's earnings record, your ex-spouse's earnings record, or your deceased spouse earning record. And I'll get into all of that and how those benefits look as well. This is an important number to note. Your full retirement age, and the next slide will go through why this age is so important. But for those dialed in who were born in 1960 or later, your full retirement age will be 67. You might also hear this referred to as your normal retirement age, right? So those same thing there. If not, it will be 66 in some months. And this is where the idea of when to claim gets tricky. And sorry, my job can be morbid, but the best way to plan for Social Security is if you knew exactly when you were going to die. And we don't know that, right? But what we can do based off of, family history or longevity risk is have a good sense of time and how many payments you'll need. But you also need to consider your spouse when claiming. And again, we'll have a slide on that too. But the idea of paying to delay here, and because this conversation goes in line so closely with Medicare, and not to jump topics, but with Medicare, you want to be on top of it as early as possible because we don't want you to face, higher premiums or even a penalty for missing a enrollment period. With Social Security, it's almost the opposite, where you kind of want to wait as long as you possibly can, right? And so that's what the next slide will cover, the difference between when you claim. But the idea here is you can claim as early as 62, and then up until 70, you can see some significant growth for those years that you claim.
Can we go, sorry, can we go back to that prior slide? Will you be covering the third bullet point, earnings test may apply if still working? You will.
Absolutely. Okay. And we have the numbers on the slide,
Thank
but
you.
Great point. We'll absolutely cover that. And it will be on the next slide, actually. This just shows how many individuals claim early. And you're probably not surprised. Why did they claim at 62? Because they're eligible, right? I don't blame these retirees, right? You've worked so hard, you've paid into the system, and you want to get your money back. So we'll discuss that too. This is a really helpful slide, right? So as I mentioned, there are exceptions to this rule, but once you turn 62, you are eligible to claim Social Security off of your own earnings record. Your full retirement age for today's conversation will just say is 67. If you claim in between 62 and 67, your benefits will be reduced because you claimed early. Once you reach your full retirement age, you're fully maximizing the amount that you paid into Social Security. So you're getting 100% of what you were owed. But you can also wait until age 70, and you might see roughly an 8% growth rate in that amount, but you're missing out on some years where you were paying into the system. For example, let's say you wait all the way until 70 because you want to get the biggest dollar amount. Well, if you pass away at 72, you're not fully maximizing Social Security for yourself, right? So again, there would be technically a perfect break even for when you should claim, but we can't project that in a good way. Now, it's not just less benefits and a reduction to your benefits to be aware of if you claim Social Security early. I always think it's a best practice to at least wait until you've retired because of that earnings test that you brought up, right? So that's that third bullet point down below early retirement. If you claim Social Security before your full retirement age and you're still earning, it is very likely that Social Security will withhold a pretty substantial portion of your payments. So if your earnings are above 22,000, as you're seeing there, this will impact you. But the earnings test no longer applies if you claim at your full retirement age. So you can work until as long as you'd like and start claiming at your full retirement age with zero impact here. And this isn't a sunk cost. So once you reach your full retirement age, even if you claimed early and some of those dollar amounts were withheld, it will be added back into the system for you. So it's, again, not lost dollars, but it's a little complicated and just dealing with Social Security, right? So we want to try to avoid that. And it's just something good to note that if you claim Social Security early, you're getting a reduction in benefits, but you're also seeing less of a payment. Maybe it's because you're still working.
Let me just highlight something that you said, and it's really important because people are working longer or they might move into self-employment. So when you hit your full retirement benefit at, say, age 67, the earnings limitation is no longer applied.
Exactly.
So you could be working. A lot of people who have a long relationship with their firm and have a high income will come back as a consultant,
Right.
this kind of thing. And you can claim your benefits and receive your benefits, but not have any reduction because you're crushing it with your earned income. I think that's really important. Can you just really quickly reiterate this idea of adding back forgiven benefits back when you hit full retirement from lost revenue at early
Yeah.
retirement?
Yeah. So these benefits that you receive are estimates, right? So when you look at your statement now, it will be impacted on if you work more, right? And that will impact the overall calculation for those 35 highest earning years. I don't know the specific ways that Social Security does this, but if you did claim early and they withheld benefits because you had earnings, it will be added back into the system. Not directly in one lump sum payment, but it will take a couple years, but you will break even. So that's more my point. It's not lost money, but it will take some time to earn that back. So you might see at your full retirement age some higher monthly benefits, and then it might lower because you've made up for it, right? So that might get a little into the weeds, but I think it's just good to know that it's not a full loss. And speaking of that too, this strategy, I wouldn't, you definitely can do it, but I think it'd be for a, one-off scenario. But let's say it's 62, you're not working and you need the income, right? That's what Social Security is for. It's income for you. But let's say come 64, you get a new job. So you don't actually need the Social Security benefits. And you wish you didn't lock in to that level at 62. Once you reach your full retirement age, you can actually suspend your benefits, wait until 70, and then from then on, you'll get that amount you should have received at your full retirement age. So this is the idea around, hey, once you claim Social Security, you're locked into that amount forever, right? Technically, yes, this is the one way around that, but definitely work with your advisor on this if it's something that you think would be beneficial to you if you need the income early. And then the last scenario is if, let's say you're still working or you don't need the income right away, or what I cover with spousal benefits and survivor benefits, you want to be strategic and wait as long as possible. There's no point in waiting past age 70, but from those years of your full retirement age until 70, your benefits will grow roughly at 8% on an annual basis. So once you do lock in that dollar amount, it will be a higher amount. And this puts some dollar amounts behind it, right? So let's say you're projected at your full retirement age to receive $2,000 a month from Social Security. If you claim as early as 62, you're seeing $600 less a month. But if you waited all the way until 70, you might be seeing roughly $500 more a month, right? So this is just putting the math behind it. This slide may be the most important slide for any of you married couples out there in this entire presentation, because I think it's where people make the biggest mistakes. And I'll use an example here. So let's say we have a married couple and the older individual, let's say they were the higher earner. We see that a lot. And maybe they're in poorer health. So once they get to age 62, they're like, hey, I may not be around as long as I'd like. So I might as well claim Social Security because I want to take advantage of it when I can. Well, once their spouse starts to receive survivor benefits, they're going to receive that lower amount. So that amount they locked in at 62. And if that spouse is healthy, the surviving spouse, let's say lives until their 90s, that's a lot of years where they've been locked into the 62 amount rather than if the higher earner waited. So I'm more than happy to take a deeper dive on this, but we do have an example of that as well. So not just planning for a survivor benefit, but also these spousal benefits. And this can impact you in two different ways. One, as I mentioned, if you never worked and paid into Social Security, you can receive up to 50% of your spouse's benefits that they would have received at their full retirement age. Now, a few rules here. In order to claim off of your spouse, the higher earner spouse, they themselves have to start taking Social Security. So let's say you're both the same age and you both wait until 67, which is your full retirement age, to claim Social Security. The higher earner will likely get 100% of their benefits, and then the spouse can get 50% of that. So you're really getting 150% of the higher earner's benefits. Now, this can get complicated. Let's say you both worked in Social Security and both have your own earnings, but one's just significantly higher than the other. Once you claim and you're both claiming Social Security, they should automatically give you the higher of your earnings or 50% of your spouse's. And a lot of times, even though it's cut in half, if there is a huge gap in the amount that they're earning, it's a lot of times still the higher amount, the 50%. So I really like this example because it helps put it into perspective how the 50% actually works. So we can read through it together. So let's say the higher earner, the husband, the benefit is $2,400 when he reaches his full retirement age, but he files as early as 62. So what do we know? We know his benefits are going to be reduced because he claimed early. Well, his spouse, his wife, she didn't claim early. So when she reaches her full retirement age and starts claiming, she's not getting 50% of the lower amount, the $1,600 amount. She'll get 50% of that amount he should have been receiving at full retirement age because she waited. Now, this is completely different than survivor benefits. But again, it is a good rule of thumb.
So you're saying husband and wife both have corporate jobs and his benefit is $3,450 and her benefit is $1,200 from her own earnings record.
Right.
So she forgoes that because 50% of 3,400 is 17 something. That's a higher amount.
Exactly.
Okay.
Yeah. And Social Security should do that automatically. So you don't have to refile. Once you both start to claim, you should automatically receive the higher of those two.
Okay.
Now, the rules change a little bit for divorced individuals and for widows. Widows are almost a completely different conversation. But you can receive Social Security benefits based off of an ex-spouse if you're married for at least 10 years and divorced for 2 years. And Social Security actually gives you a gift. If you recall on the last slide, in order to claim based off of your spouse, they have to have started to claim themselves. That's not the case for divorced individuals. They just have to be of age of 62. So if you're married for 10 years, all you really need to know is their birth date. So that should probably be a given if it was a 10-year relationship. So that means you don't have to call and say, hey, have you claimed yet? When are you going to claim? Please claim, right? That doesn't impact you. So once that spouse is 62, the ex-spouse can then start to claim the 50%, similar to the conversation earlier, off of their earnings.
And I believe it's nice to know you don't have to stalk your spouse to get it done. That's cool. I also believe that when you file or as you're thinking about filing, if your ex-spouse is remarried and their new spouse is getting a 50% benefit, you still get your 50% benefit as a divorced person.
Correct.
Right?
They do not impact each other. Exactly. Yeah. There are some rules about remarrying. I think if you remarry before 60, you're no longer eligible. So again, there are some ins and out rules there that if it's your scenario, we can look into more. But widow benefits are a massive conversation. So this conversation is really around the survivor benefits. So when one individual passes away, what do those benefits look like? Well, a widow can receive benefits as early as age 60, which also isn't entirely true. They can receive benefits as early as they need if they're the caregiver of a child of the higher earner, and they're under 16. We were talking about this too. Children of the higher earner who passed away can also receive benefits based off of their earnings record if they're under 18 and unmarried. It also can increase or be around for another year if they're in school full time. But again, these are some loopholes to that rule. But also it's typically unfortunate because that means there was, a very early death, typically when we see this. So this is based off of the family maximum. So as a family unit, you can get close to 150 up to 180% of that higher earners amount at their full retirement age. And again, if there was a divorce involved, their amount they're receiving won't be impacting that dollar amount.
All right, let me ask you this. What if one spouse files early and keeps working so they get reduced payments? But then they switch to the 50% of their spouse's higher earnings benefit when he or she files. Does that first spouse get reimbursed for their reduced payments? Did I ask that right?
Yeah, let me see 1 second. Then switches to. Okay, so the idea is you both, and correct me if I'm wrong here, but you both have your own, you're a married couple, you both have your own earnings record. And one spouse claims early based off of their own earnings record, right? So it's a reduced amount and likely less. Once that other spouse starts to claim, this one, I know some of this might be audio, so whatever. The earlier spouse who claimed early, who is likely making less money, as I mentioned earlier, will automatically get the higher of what they were receiving or 50% of their spouses, but it will still be reduced because you originally claimed early. Right? So at 62, you can claim off your own earnings. Once your spouse starts to claim, whenever that may be, you might likely get bumped up to his or her 50%, but a reduced amount off of that because you originally claimed before your full retirement age. I think that was the question.
Okay.
And correct me if I'm wrong too. But
Yeah,
what we're
so it sounds like, I mean, sorry to interrupt. It sounds like there is no reimbursement in that example.
Right.
correct.
Right.
Yep. Once you claim early, you're claiming early. Now, good transition here too, because that doesn't mean you're claiming early for your survivor benefits. So these rules used to apply to spousal benefits when you're both alive, but now it's only if there's a survivor benefit situation where you can claim one benefit, so either your own earnings record or the survivor benefit, and let the other one grow. So that's the second bullet under the widow's benefit. So if your spouse passes away and you wait until your full retirement age, you will get 100% of what your spouse was receiving or what they would have been receiving on the date they passed away. So let's say an individual, they're both waiting on Social Security, and one individual passes away at 68, right? Once the surviving spouse reaches their full retirement age, they'll get the amount that that individual is supposed to receive at 68. Now, let's say there is an early death, which we never want to see. You're not going to be penalized for that early death. So if it's before your full retirement age, it's just all based off of full retirement age. But if the reverse occurs, where the higher earner spouse waits until age 70 to claim, if the surviving spouse waits until their full retirement age, they can receive 100% of that 70-year-old age amount. Right, so that's what this slide is showing here. Again, you can claim it as early as 60, sometimes earlier, but it will be reduced because you claimed early. If you have your own earnings record, You could, as early as age 60, claim your survivor benefit at a reduced amount because you claimed early, but let your own earnings and benefit grow until 70. So depending on the dollar amount, that can make sense. Or vice versa, you can claim off of your own earnings record early, as early as age 62. And yes, it will be reduced. But once you reach your full retirement age, switch over to your survivor benefits to
Wow.
maximize those. So this is the only way you can now take one and let the other grow. You used to do that with just spousal benefits. That's no longer the case. Pretty straightforward here. It's just likely that your Social Security benefits are going to be taxed. That income level is based off of your modified adjusted gross income plus half of your Social Security benefits. So if that level for married couples is over $44,000, up to 85% of your Social Security will be reported as taxable income. So again, just a good thing to be aware of, not much we can control there. And to be respectful of time, more than happy to use the chat feature, or if individuals can go off mute, we can use this time for some Q&A. But these last two slides I definitely want to show are the impact of receiving a public pension, right? So you worked for a public company, you didn't pay into Social Security, but you want to receive that 50% spousal benefits or survivor benefits. It's likely that your Social Security benefits will be reduced. Or the other side of things, let's say you spent 20 years in the public space, 20 years in a private corporation, you can't double dip there either. You can't get 100% of a pension and 100% of your survivor Social Security benefits. So this is an example of those two situations. But again, these are laid out in a brochure that I can send out as a follow-up for you all. But happy to pause here and see if there's any questions or comments.
I have one question. If one spouse is full retirement age and decides to take benefits, and the other spouse wants to cash in on half of that, do they have to be full retirement age to get the full half of that? Or if they're 63, can they get the full half of that? Or how does that work?
Correct. They have to be their full retirement age to get the full 50%.
Okay.
But
And if
they
they wait,
can.
if they wait longer than full retirement age, they will get more than whatever the percentage is above the 50?
Great question for asking. Great question. Because no, when it comes to spousal benefits, so claiming off of your spouse, whether it's spousal benefits or survivor benefits, there's no point in waiting past your full retirement age. The growth from 67 until 70 is only for your own earnings record. But there's no point in waiting on survivor benefits or spousal benefits past your full retirement age, say 67.
And the spouse, if the spouse collects earlier than full retirement age, their benefits will be reduced.
Correct.
Okay, thanks.
Even if it's based off of the 50%, it will be less than 50%.
Correct. Got it.
Great question. There's a question here I see. So plan on working after age 62. If you make roughly $60,000 and business expenses, would it make sense to collect at age 62? So that's why it's so tough here. If there was one best way to claim, everyone would do it, right? So it really depends on your situation. The first thing I'd ask is, do you need the income, right? If you need the income, maybe it makes sense to start claiming at 62. Is there a spouse involved? Are you the highest earner? Are you locking into that lower amount? In this example, it is likely that your benefits would be withheld. Again, you'll make up for that at your full retirement age. But that's also why I say it is, in my opinion, a best practice to wait until you've stopped earning in order to claim Social Security or your full retirement age, whichever comes first. But life happens. If you need the income at 62, by all means, it's your money, right? I don't know if I really helped with that question.
if a self-employed person through their Schedule C and their ability to control expenses can arrive at a net income that's under that taxability threshold or right up to it, then you could take your early benefits and not lose any to taxation, but then it reverts back to all the traditional questions you were asking. I do think there are a lot of people who probably could benefit from taking at age 62 because they
Right.
probably have somewhere in the neighborhood of a 11, 12-year break-even point.
Exactly.
And, you know, during that 11, 12 years, if it's important bridge income and it makes you feel comfortable that you've had a reasonable return on all of the deposits you've made, and that's kind of peace of mind.
Right.
So, you know, can be a good thing in certain cases.
Exactly. That's why it's always a case by case basis.
Can you speak just a few minutes to just getting the Social Security underway? I mean, is it arduous? Is it easy? Is it all
Yeah.
online now, or do you have to go to an office and wait for an hour?
Yeah, I mean, it's pretty straightforward online, that process. I'd say the first best practice is to make sure that you've created an account on myssa.gov. It's never too early to do that. And keep an eye on your earnings record there and make sure everything seems aligned. And then I would say it is a best practice before you start to claim to set up an in-person appointment with a local administration, just because a lot of what you covered today and that you'll get from working with your advisor, it will be very helpful. So you'll come prepared to that conversation, but just confirming like, hey, I'm planning to claim in a couple months because I'm reaching 67. Just wanted to confirm that this is the type of payment I'll see. It doesn't hurt as the best practice to set up an in-person meeting before, but yeah, you can claim right on the website. Pretty straightforward.
Could I ask a quick question?
Yep.
Of course.
As a single person, I presume that all of these other things are not relevant, and you just wait until either you've reached your full retirement age or you're as old as you can tolerate
Yeah.
and just start taking. There are no nuances to when you take it, right?
Exactly. Yeah. So when it's based off of your own earnings record, the idea between age 62 and 70, right? And what makes the most sense due to your scenario, right? Because you can see that growth until 70. So it'd be a conversation around if you need the income, life expectancy, and then also if you're still working, those things should be taken into consideration, but you nailed it. Pretty straightforward there.
Thank you very much.
Yes, thanks for joining.
Great. Thank you all for coming. This is fantastic turnout. Thank you so much, Grace, because I know you have a busy week. And again, if anybody wants to work with her directly, give Dave Callahan a call, and he always gets you to where you want to go.
Thank you for having me. It was nice to meet you all, and
You
have a
too.
great evening.
Peace.